Most business owners work hard. Very few allocate money intelligently. They chase revenue, celebrate profit, and then wonder why stress never goes away. The problem is not effort. The problem is capital strategy. If you do not tell your money where to go, it disappears into expenses, upgrades, and random decisions. Today, we are breaking down the 10-5-3 rule and how it can transform the way you manage business finance. Rule number 1, the 10% rule. Aggressively reinvest for growth. The first part of the 10-5-3 rule focuses on high return reinvestment inside your own business. This is your growth engine. Most small businesses can generate returns far higher than traditional investments when capital is deployed correctly. If you invest $50,000 into equipment that increases production capacity and it generates $10,000 in additional annual net profit, that is a 20% return. That is powerful. But here is the key. Reinvestment must be intentional, not emotional. Do not reinvest just because you feel excited. Reinvest when you can clearly answer 3 questions. 1. Will this increase revenue? 2. Will this reduce long-term costs? 3. Will this improve operational efficiency? For example, upgrading outdated software might cost $15,000 today, but if it saves $2,000 per month in labor inefficiencies, that is $24,000 per year in savings. That decision compounds. Marketing can also fall into this category. If you spend $10,000 on targeted advertising and track a clear, measurable return of $20,000 in gross profit, that is a smart growth allocation. However, not every opportunity qualifies. Expanding too fast without cash flow clarity can destroy stability. Growth without margins is dangerous. The 10% bucket represents calculated risk. It is not gambling, it is disciplined expansion. As a business owner, your highest potential return usually sits inside your own operations. That is why this rule places aggressive reinvestment first, but it must be backed by numbers, not optimism. Growth is exciting, but controlled growth builds wealth. Another important layer of the 10% reinvestment rule is tracking return on invested capital consistently. Many owners invest once and assume it is working. Smart owners measure it. Every dollar you reinvest should be tied to a metric. That could be customer acquisition cost, gross margin improvement, production efficiency, or revenue per employee. If you invest $20,000 into a new sales system, you should know exactly how many new customers it generates and how long it takes to recover that investment. This is called payback period. If the payback period is 12 months or less, that is usually a strong signal. If it stretches beyond 3 years, the capital may be better used elsewhere. Growth is not about spending more. It is about multiplying each dollar. The 10% rule becomes powerful when you treat reinvestment like an internal investment fund, not an expense. That mindset shift alone separates stressed operators from financially disciplined business owners. Rule number 2, the 5% rule. Diversify outside your business. The second part of the 10-5-3 rule is where many entrepreneurs struggle. They assume their business is their only wealth vehicle. That mindset increases personal financial risk. The 5% bucket represents stable, diversified investments outside your business. Why does this matter? Because your business already carries concentrated risk. Industry shifts, economic slowdowns, regulatory changes, competition, supply chain disruptions. These are real factors. If 100% of your net worth sits inside your company, your personal finances move up and down with business volatility. Imagine you generate $200,000 in annual profit. Instead of reinvesting all of it, you allocate a portion into diversified index funds, bonds, or retirement accounts. Historically, diversified portfolios may average around 5 to 8% over long periods. If you invest $50,000 into a diversified portfolio and it grows steadily at 5% annually, you are slowly building a second pillar of stability. This is not about getting rich quickly, it is about reducing fragility. Smart business owners build wealth outside their primary income engine. That way, if the business hits a rough year, personal financial stability remains intact. This bucket also protects you emotionally. When markets fluctuate, you are diversified. When business fluctuates, you are diversified. 5% may sound modest compared to aggressive reinvestment, but long-term consistency matters more than short-term excitement. The 5% rule reminds you that wealth is not just built by working harder inside your business. It is built by protecting your personal balance sheet. Another powerful benefit of the 5% rule is emotional separation. When all your wealth sits inside your business, every slow week feels personal. Revenue dips create anxiety. Market shifts feel like threats to your identity. But when you build assets outside your company, you create psychological balance. You stop making reactive decisions just to save the business. You think clearly, you negotiate confidently. Diversification also improves long-term retirement security. Your business may eventually sell, scale, or slow down. External investments keep growing quietly in the background. The 5% bucket builds stability that most business owners underestimate until they truly need it. Rule number 3. The 3% rule. Protect liquidity and survival capital. The final part of the 10-5-3 rule is the least exciting, but it is the most powerful during difficult times. This is your 3% bucket. This represents cash reserves and liquidity. Cash does not generate high returns. It might earn 2 to 3% sitting in a high-yield business savings account. That sounds boring compared to expansion or investing, but this bucket is not about growth. It is about survival. Every business faces unexpected events. A slow quarter, a delayed payment from a major client, equipment failure, sudden tax obligations, economic slowdown. When cash reserves are weak, small problems turn into financial stress. A healthy business should maintain at least 3 to 6 months of operating expenses in liquid reserves. If your monthly expenses are $40,000, that means maintaining $120,000 to $240,000 accessible. That cash buffer buys time. Time to adapt. Time to adjust strategy. Time to negotiate. Time to survive. Without liquidity, business owners make desperate decisions. They accept bad loans. They slash prices. They over-leverage. They panic. With liquidity, you stay calm. This bucket may only generate 3% annually, but its return is psychological stability. It reduces stress. It improves decision-making. It strengthens negotiation power. In business finance, liquidity equals control. The 3% rule reminds you that not every dollar must work aggressively. Some dollars must simply stand guard. Mastering business finance is not about chasing the highest return every time. It is about allocating capital intentionally. When your money has structure, your business gains strength. And when your business gains strength, you gain freedom.